Hello, everyone. Good to see you all. Thank you for taking the time to join our session. This is slot number 1 of our monthly market session. The objective of these sessions for the new joiners is to provide you with an update on what we see happening overall in the B2B software and technology space, having a bit of a community approach to share what we see happening, looking at what is happening in the public markets, and we'll cover that just now. Today, we have a guest joining us with Maxime, topic lead on the Office of the CIO space, that will provide us with his perspective on the AI disruption that we see happening or not in that space. So we'll cover that in a bit of depth today. And then we'll provide you with additional insights on the deals and the usual numbers that we track, to then go into Miguel telling us today about what we've seen happening from an earnings perspective, with a good number of companies that have released their up-to-date numbers. A bit of an update for today's session. We have a Q&A feature that has been activated on Teams. This we will do it in a written format, but you can ask your questions along the way, and we will come back to you in offline mode, but super important that we hear your thoughts and feedback along the way. So this feature has been activated. Don't hesitate to let us know, in particular, specific analysis you'd like us to run, or questions that you have in your beautiful brains that we can help answer, hopefully. Happy to get your thoughts from this perspective as well. The goal is to keep that as interactive as possible. Let's get going with today. If we can move to the next page, Ray, to first tell you about what we see happening overall in the market. So this is covering performance, next page please, for what we've seen happening in the past few weeks in February. So this is a chart that we show you every single month. We keep tracking performance in the public market of a basket of just under 260 B2B software and technology companies in North America and Europe. And we track the monthly performance. So what you see in the top layer of this chart is Feb. And below you have year-to-date 2026. I guess nothing new, because you've all seen or get notifications on your phones. Markets are down heavily across the board, and in particular with technology. If we look at the numbers for February, you can see that wider indices are in negative territory. S&P 500 and NASDAQ are negative, but you can see that the cluster that is impacted the most is the B2B software universe. Our 259 companies are down minus 8.3%. This is a very strong correction. And if you look at things from a weighted perspective as well, thinking about the market cap of the hyperscalers reflected, it is a very strong negative territory as well. We split companies by cluster, so where they sort of fit, and you can see that this is across the board. Every single cluster of technology is down, including the majors, down minus 10% on average, which is usually not the case. There is only one segment that is up 1%. It's infrastructure software, pretty much companies that are as close as possible from the data and AI stack are in favor. The rest is in trouble. This is basically what we see happening. If you look at things from a year-to-date perspective, this is reflected below. You can see that wider indices are neutral or down. NASDAQ is negative so far in 26. And you can see that B2B software at the moment is down almost 18%. So this is major correction territory. You can see that reflecting across the board, with all of the clusters that are down 15 to 20%, with some specific segments that are impacted more. Think about CRM, CMS marketing, supply chain procurement, which is down heavily as well, high double-digit negative. We will reflect a little bit on that over the course of this, but let's now look with Julia at what does it mean from a valuation perspective, because we are reaching numbers that are worth showing you and discussing.
Thanks, Ben, and good afternoon, everybody. Ray, you can go to next page, please. So in line with stock performance, the EV over sales of the software B2B universe is now down 25% year to date, from 5.6 times at the end of 2025 to 4.2 times at the end of February. As we can see from EV to sales standpoint, valuations are trading at multi-year lows at levels last seen in Q1 2017. So this means that valuations are even lower than what we saw during the COVID pandemic. Given the global geopolitical situation, we remain cautious, of course, but from a value perspective, this could be a good opportunity to start looking at names with good fundamentals and with minimal AI disruption risk. We see a similar trend in EV over EBITDA, which declined from 20.4 times in 2025 to 15.3 in February. If you go to next slide, Ray, please. The fundamentals remain the same when we look at EV over sales by valuation cohorts, with higher growth companies valued at higher multiples. However, all cohorts are down year to date in EV over sales by more than 20%, with high growth being at 7.6 times EV over sales, mid growth at 3.9 times, and low growth at 2.9 times. If we go to next slide, as a reminder, here we look at a rule of 40, and rule of 40 is revenue growth plus free cash flow margin. So here we look at valuation by type of rule of 40, and they continue to decline across all rule of 40 cohorts. The dark line here represents companies with a rule of 40 or above, and they are currently valued at 6.9 times EV over sales on average, down from 9.3 times at the end of the last year, 2 months ago. The valuation is much lower for the rule of 2030 at around 3.4 times, down from 4.4 times in 2025, and it's even lower for rule of 20 companies now trading below 3 times. If we go to the next slide, here we compare EV sales to growth versus EV sales to free cash flow margins. And since May 2023, we have seen that revenue growth has traded at a significant premium to free cash flow margins. This valuation spread peaked at 77% in March 2025, but compressed to 45% in January. While the market still values top line expansion highly, the premium relative to cash flow is clearly normalizing. So if we go to next slide, please. Yes. No, okay, no questions.
Just wanted to say in the previous page, Julia, because it's still worth mentioning, below in the chart, you can see the average growth. If you go to page before Ray, sorry, you can see the average expected growth in 26 for the basket of companies that we cover. Looking at consensus expected growth, you can see a bit of an inflection versus 25. So we'll continue to monitor that. The universe is still slow growth, 11% on average, but expected to pick up from the absolute low that was 25. So that's a number to keep in mind, and we'll keep looking at it for you.
Yes, thanks, Ben. If you go to next slide, so here we compare North America with Europe. So the premium for North American companies continues to be elevated in February. If we look at the valuation for European companies, we are close to 2.7 times EV over sales, the lowest level seen in the last 10 years. As always, the premium can be, of course, explained by higher growth numbers for North America at 11% and 4% for Europe. However, growth rates for Europe have potentially started to reach an inflection point from 3% in 2025 to 4% projected for 2026, as we see these with the premium growing down slightly between North America and Europe from around 90% in December to now 77% for the month of February. And if we go to the next slide, so moving here on the macro perspective, US inflation cooled to 2.4% in January, down from 2.7% in December. However, it is still above the Federal Reserve's 2.0 target. Both the ECB and the US Fed held rates. This tells us that decline in valuations isn't necessarily because of interest rates or rising inflation, but it is caused by other macro factors right now, including AI disruption risk and broader geopolitics. So now leaving it to Maxime to do a deep dive on the Office of the CIO topic.
Hello, everybody. Thank you very much, Julia. So indeed, zooming on Office of the CIO and Office of the CTO. So before zooming on the deal activity over the past 3 months, as this is a space that might not appeal to everybody, to give you a bit of a view on how we break down this space at Dedale, as it's an active universe we are tracking among others. We look at Office of the CIO and analyze it under 3 main subsegments. The first one being IT operations management. So this is a big cohort made of IT service management, IT asset management, the solutions of the IT administrators, the IT managers, and the CIOs. Observability solutions that are really here to help analyze and monitor the performance of IT estates from cloud, data centers, back-end assets as well as front-end assets. And finally, DevOps, so all the solutions supporting the development lifecycle, productivity tools for developers, etc. So overall, this Office of the CIO and CTO's universe remains rather active in terms of transaction. Over the past 3 months, we see that venture and growth as well as corporate acquisitions remain like very important in the space. Corporate acquisitions are mostly motivated by the desire for platform players to consolidate point solutions, and this can happen at mid-market as well as enterprise level. And as it's a space with heavy innovation and disruption as well, it's also quite active in terms of venture and growth. And we've decided to highlight a few deals over the past 3 months. So we can see, for instance, in corporate acquisitions that ITRS, so an observability platform, a mid-market platform, has acquired like Ekara, a point solution in user experience monitoring to consolidate their observability platform. Flexera, IT asset management platform, has consolidated Prosper Ops for cost optimization. In terms of growth investments, we also wanted to mention, of course, probably a deal that you've seen on your radar, backing and fundraising led by Menlo over Lovable, a vibe coding platform that's highly disrupting the DevOps space. And finally, one buyout deal that we wanted to emphasize on, which is the Redgate growth investment received by Bregal Sagemount. It's a deal we've also been tracking a lot. Redgate is a very interesting asset. It was one of the main primary deals in the Office of the CIO space. Took place early 2026, and it's a very interesting UK-based company doing database development and database monitoring software. Moving on maybe to the next page, Ray. Here we just wanted to emphasize a little bit like some of the perspectives that we get speaking to CIOs, surveying different CIOs as well, as part of the continuous work we're doing on this space. And what stands out is optimization, both of like IT spending, but also usage, as well as like automation, remain like priority themes for CIOs and CTOs, which is interesting as all the 3 main categories that I shared earlier when we break down the CIO and Office of the CIO and Office of the CTO space, so being ITOM, DevOps, observability, perceive and observe a very important amount of innovation with AI offering important opportunities. So for instance, in ITOM, you are going to have a lot of like new point solutions doing automating the issue resolution, the ticketing processing and everything. DevOps as well, highly repetitive and workflow intensive space with lots of like processes that can be automated around like the code deployment, the code reviews. And observability, which is also benefiting from AI as the use cases are becoming more complex, the data sets more difficult to analyze. And so in this context, AI is also bringing a lot of opportunities. And we actually see this in notably the number of like deals that are happening. ITOM and DevOps concentrate most of the deals that have took place on the space, with most of the themes being and most of the targets being like innovators in the space. Maybe moving on to the next page, we wanted to lay out here a view showing a little bit 4 main subsegments. So I introduced 3. We just split IT operations management into 2, IT asset management and IT service management. And over this view, you will see basically how each subsegment position in terms of segment attractiveness, so market maturity, etc., and how we see them exposed to AI disruption. First thing to illustrate and to mention is the disruption risk faced by DevOps, and this is also quite justified by the amount of like capital and growth deals and mega deals that have been observed in this space, with vibe coding basically like threatening the whole DevOps landscape. So that's why, although it's a highly attractive segment, offering high growth potential, it scores very left and very high in terms of AI disruption risk. This can be justified by the fact that you're going to have a lot of repetitive tasks, highly automatable. It's a horizontal use cases and rather peripheral in terms of like positioning within a broader stack. On the opposite, we're going to have IT service management, which is a little bit more mature segment overall, highly dominated as well by ServiceNow, which will explain why the segment is a little bit seen as less attractive compared to others. However, given its core nature, the high specificity of the workflows, it's not peripheral software, it's very centralized, there are going to be a lot of users, it's highly business critical. We perceive it as rather protected from AI disruption risk. And overall, one message here is around the positioning of monitoring and observability software, which seem to offer the best trade-off between relative like AI protection from AI disruption risk, as well as attractiveness. And if we move to the next page, Ray, this will be illustrated if we look on the top left graph on the valuation levels. Historically, software development lifecycle vendors had a valuation premium compared to the rest of the CIO, office of the CIO software vendors. Today, due to AI disruption risk, monitoring offers the best trade-off. And so that's why we can observe like a valuation premium coming from these players. That's all on the Zoom. Always happy to answer questions offline on this very interesting space. And back to the team for the next of the market session.
Yeah, thank you, Maxime, for these updates. So this is just a snippet, a few minutes, but an approach that we have segment by segment to tell you a bit what we see and some of the high-level findings of looking at disruption in those spaces, as well as what is going on in terms of transactions and overall strategic activity. Maxime is your go-to if you want to go deeper on this topic. There's a lot on the platform, plus happy to have those one-on-ones to go into details. Continuing the session of today, going to the next section, which is about deals. Happy to cover them quickly today. We're still in the middle of Q1, so the numbers are not yet firmed up. We'll provide a more definitive view on transaction traction for the first quarter in a few weeks. Nevertheless, some of the trends are starting to pick up, and happy to comment as well on what we see happening qualitatively in the space. Commenting on that first, obviously what is going on in the public markets is having a bit of an impact on the private markets as well, but we see that in a bit of a differentiated way. We would say the impact is felt a lot at large transaction, large buyout level, typically with the big franchises that are thinking about how to go about this, how to price assets, how to price the future of assets. From that perspective, we do feel a little bit of a wait and see approach to be able to price things out, considering what is going on. So on the large transaction side, we do see some tame approach. However, there is one trend that is feeling stronger than ever, is the opportunity of taking assets private. Considering a big decline in public valuation levels, the appetite of private equity sponsors with deep pockets to take companies out of the public market, maybe to help them work on themselves with a medium-term outlook, taking them out from the quarterly scrutiny of the public markets to help these companies transform themselves, AI powers themselves, maybe working a bit on the business model to go beyond the seat-based model to go to a bit more AI-proof type capabilities. This is a trend that we feel may come up more and more. One example of that is the completion that you can see reflected in the numbers of the take private of Dayforce, for example, which is a massive one. We do expect to see more of those mega deals, which are probably going to be public to private type transactions. If we go to the next page on corporate M&A, and I forgot, in the world of private equity, we do see continued activity on the small and mid-cap band. However, obviously, there's a lot of questions out there on the risk of AI disruptions. Investment committees are figuring things out. Nevertheless, we do feel strong appetite. There is a lot of money to deploy. There are companies that need to transact. And so we do see continued appetite across the board in North America and Europe, even though there are a lot of key questions to think about out there. Going into the corporate transaction world that we keep a track of as well, so far, The numbers start a little bit lower, but qualitatively, we do feel that there is a lot of activity and appetite from corporate consolidators that are looking out for potentially attractive acquisitions at fair prices, as well as large platforms that are looking to consolidate their space, acquire differentiated point solutions to enhance their overall platform positioning. We do see a lot of activity on this front. However, because of valuation levels that are a little bit tricky to price these days, there's also a little bit of figuring out what is the right price for companies these days, but we do see some strong appetite across the board. Finally, for VC and growth funding, Ignacio will go into the details. If we move to next page, sorry. Ignacio will give you the details on what we see on the AI front with a dedicated section that we are building and continuing to invest in. You can see the numbers for Q1 are through the roof again, with mega raises on the AI side, with many large companies that are continuing to do mega raises and not coming to the public markets yet. We'll reflect on that just after, but it's not only AI deals that are raising a lot of money. We can mention, for example, a very large raise by Kraken in energy software, over 800 million. So this is a very large deal for an application type company that has seen a lot of traction in the energy vertical software space. Now you will see in the next few pages a good number of deals that are curated to give you a little bit of the information on them. If we move to the next page, Ray, this one I will not go into the detail, but you can see, and we move to next page, but you can see that the CyberArk deal has been completed there. Here, interesting to mention, for example, Core on the top left as a public to private deal. Just to mention, here we are in the healthcare IoT space. It's a fairly large public to private deal. It's just to exemplify the fact that we are likely to see more of these transactions going forward, and we'll keep monitoring what we see. Continuing, if we continue to move, please. Yes, this one I will not comment. It's AI stuff that Ignacio will comment as well. The last one, indeed, spending a bit of time here in application software. Two themes worth mentioning as we do feel things are happening. So one is two deals in the field service management space. The merger between Total Mobile, which is a recent 5 Arrows deal, with Solvares, which is another field service management company. So we are looking here at European field service management software. This is a space that we have been looking at for a long time, and we're expecting to see some consolidation with a good number of local leading solutions in specific geographical markets, as well as some vertical leaders in specific end markets that they serve. We can see a start of that consolidation happening, with definitely a space that is ripe for European champions to come and emerge. Good to see 5 Arrows going their way into starting to make this happen. And another deal in the same space is JobLogic. This is a Vista deal, very interesting company in this attractive space. So we can expect to see more action to happen in the field service management space. Another vertical that we see a lot of activity in. So we mentioned Kraken just before. There is a large transaction that happened a few weeks ago with Volue, a company that attracted a lot of interest in the private equity landscape. So it's a Nordic company providing energy, software, and intelligence to optimize things. Very strong company, experiencing a strong traction overall. T8 Associates led that transaction eventually. So worth keeping this one on the radar. We've actually done quite a lot of in-depth work on the energy vertical that we'll probably comment on in a few sessions. But if you want to go into detail, happy to take this one offline. Ignacio, is it possible to get the quick update on the AI front with you?
Yes, absolutely. Next page, please, Ray. So hello, everyone. And sorry, one more page. There you go. So this is the top-down analysis focused on the AI-related deals made in February, as well as the 2026 year-to-date. So jumping right into the full picture here, 2026 has had a very strong start to the year, with already $184 billion in total AI investments. Despite only being 2 months in, 2026 is already on track to being the highest year on record, already nearly catching up to 2025's total of $223 billion. So zooming in on February, we saw $150 billion invested across 117 deals. And in the next slide, we'll see pretty much why this is so high. So here on the mega deals, or deals over $500 million, in February, we saw 6 of these. So the first 3 being the foundational models, where first we have OpenAI, which raised an incredible $110 billion in venture funding, led by Amazon, Nvidia, and SoftBank. Then we had Anthropic, which also raised a very strong $30 billion in a Series G, led by GIC and Co2. Then we have the last foundational model, which is World Labs, which raised $1 billion in a Series C, led by AMD Ventures, Samsung, and Nvidia as well. So aside from these foundational models, on the mega deals, we also have Cerebras, which is a hardware company that designs processors for AI training and inference. They raised $1.1 billion in a Series H, led by Tiger Global Management. Then we have MatX, which is a hardware company as well, where they manufacture high-throughput computer chips to build LLMs. They raised $500 million in a Series D, led by Sequoia Capital. Then lastly, on the mega deals, we have 11 Labs, which is a voice AI company primarily focusing on marketing and customer experience use cases, where they as well raised $500 million in a Series B, led by Jane Street. So collectively, these mega deals saw around $143 billion in funding, taking up almost 95% of the total February investments. So on to the next slide. If we look quickly beyond these mega deals, we can see that if we exclude all of these huge outliers such as OpenAI and Anthropic, deals are still picking up. So in this slide, we can see that February still shows strong performance, obviously not quite as strong as including the mega deals, but they still showed that February was the 4th highest month overall since the beginning of the study, with $7.3 billion invested across the remaining 111 deals. And to go a little bit more in depth into February, we can actually go to the next slide. So looking deeper into the February segmentation, still excluding the mega deals, we can focus on the 5 segments that received significant investments, where the first being the Office of the CIO, which raised around $900 million across 11 deals. Notably here, we have Fundamental AI, which raised $255 million and is a data management platform. Next, we have the Office of the CFO, which raised around $550 million across 6 deals. Here, notably, we have Payne, which raised $250 million and is a digital billing and automation tool. Then Financial Services, which raised almost $400 million across 11 deals. Here, notably, we have Anchorage Digital, which raised $100 million and is an asset management platform. Then we have Corporate Productivity, which as well raised around $400 million across 7 deals, where notably we have Jump AI, which raised $80 million and is a business automation tool focused on workflows for financial advisory. Then lastly, we have Energy and Utilities, which raised around $350 million across 5 deals, where notably here we have Ubiquia, which raised $100 million and is a grid monitoring system for urban utilities. On to the next slide. So beyond the quantitative analysis, part of our objective as well is to do a zoom in on a couple of use cases that we believe are interesting or worth having on your radar. So here, having said that, I'd like to spend some time to talk about the company Rospace, which is an AI knowledge management platform that focuses primarily on research for investment firms. So they're essentially an AI native research environment aimed at transforming fragmented institutional knowledge into compounding competitive edge. Some typical use cases for companies such as Rospace are portfolio monitoring, investment thesis reuse, credit portfolio optimization, and compliance-aware discovery. So overall, Rospace is essentially a knowledge and productivity accelerator mainly used by analysts and portfolio managers for various deals. Aside from these typical use cases, Rowspace sets itself apart as well through AI empowerment, which would help with the likes of automated data synthesis, which saves significant time and money in ramping up deal research, semantic knowledge retrieval, which further reduces costs and saves more time by eliminating redundant research, which may have been conducted in earlier similar deals. And lastly, as well, in enhancing compliance automation by ensuring proprietary data is only used within set boundaries. So these AI-empowered solutions are progressively growing and further disrupting the way that traditional research workflows typically operate, which is why we believe that cases like these are worth having on your radar. That's it on my end, so I'll give the floor back to Julia, who will be covering the IPOs.
Thank you. Thanks, Ignacio. If you go to the next page, please. Yes, on the IPO side, there has been no significant noteworthy IPO in B2B software world due to bad macro environment, notably SaaS valuations that declined, AI disrupting subscription models, and recent IPOs performing poorly. And if we go to the next slide about the recent IPOs performing poorly, indeed, we see that since IPO, the valuation of most 2025 IPOs has been underperforming as investors shifted towards defensibility and moat against AI, leaving most of the upside concentrated in AI-related names. So now leaving it to Miguel for the earnings update.
Yep, thanks, Julia. Next page, please, Ray. Next page. Next page. Yep, perfect. So let me just share some high-level updates we're seeing on valuations per segment and some highlights on companies that released Q4 earnings. But first on this one, so on the valuation per segment compared to their 10-year historical EV sales, so the chart at the middle. So since last year, we continue to see premiums from majors, cybersecurity, and infrastructure software. However, these premiums have now lowered except for majors given their position in the market and growth of cloud, which I'll touch on later. But for the likes of ERP, HCM, and accounting, cybersecurity, and infra software, these segments lowered as companies in these buckets, just like other segments, got hit by the decline in valuation. But what's interesting is that what we are seeing here is that these are actually segments where AI expands demand. So for example, cybersecurity requires AI guardrails, and for infrastructure to provide AI workloads with more data storage, processing, and whatnot. And for ERP, HCM, and accounting, it's for their durability of core platforms as a relative defensibility versus AI disruption. Moving on to the earnings, next slide. There are 36 companies that reported earnings with stock price performance after earnings release, evenly split, despite 32 of them beating consensus. So this has been a narrative late last year as the market sentiment has shifted on the verdict of which companies are more prepared for an agentic platform shift. I'll provide like key insights and not go through each one of them, but on the next slide. Yep, we've listed some highlights on each of the company, but to sum it up, I've prepared key highlights, key takeaways we're seeing from Q4 earnings. First is that the market is actually splitting core infrastructure versus your vulnerable software seats. So what we're seeing is that the market has stopped rewarding this generic AI hype and is now actually strictly evaluating how easily a company's software can be replaced by new AI tools. And companies are relying heavily on charging per user, so that's seat-based pricing. It's actually facing skepticism and questions from investors right now, as investors actually fear AI will automate those human roles and reduce the need for those licenses. So for example, Shopify and Monday.com saw poor stock price performance. They're down more than 15% in a decline. And it's partly due to those fears that AI could disrupt their ecosystem or reduce the need for human software seats. On the other hand, we see infrastructure companies like Cloudflare and Datadog are being rewarded because their platforms, their systems are actually essential to build, to run, and to secure AI operations, as I've mentioned earlier, as part of the segments where AI expands demand. Industry-specific software providers like Bentley Systems and PTC are thriving because they own like massive secure engineering data sets that public AI models cannot easily copy, so making their positions relatively defensible. Second one is this AI-powered automation is actually driving cost reductions. So what that means is that this era of like growth at all costs is officially over now. Today, the market actually rewards companies that use AI to automate their own internal operations, reduce headcount, and expand their profit margins. So, software vendors are now fundamentally changing how they operate, using AI to achieve the same or better output with significantly fewer employees. I'm sure you've heard of it. Block is a prime example of this trend. So, their stock surged 15% up after announcing a 40% workforce reduction, and that returns their headcount to their 2020 levels. And it's a move made possible by AI productivity gains. Another one following the steps of Block is this company called WiseTech Global. They announced a restructuring program aimed at cutting headcount by up to 50% as well in its product development and customer service teams by also leveraging AI automation. A third key trend here, so this the third before the fourth one is that this shift to large enterprises is actually exposing weaknesses in the small business segment. So what this means is basically these software companies, they're shifting their focus away from SMBs, which tend to cancel contracts more frequently and has a relatively higher churn, and are now targeting large enterprise clients. These larger clients want to reduce the number of software vendors they use, rewarding providers that offer more of a suite offering. So an example of this is that Workiva and Tenable is showing this. So Workiva, what they actually did was that its large contracts over 200K and ACVs grew 42% as their clients bought multiple solutions, while Tenable is seeing strong adoption of its unified platform as customers drop fragmented standalone tools. While on the other hand, companies heavily exposed to smaller businesses are actually struggling. So take note, for example, JFrog, it's down 10%. It's deliberately dropping roughly 300 of its low value clients to focus its resources more on the larger enterprise deals. And Monday.com, another one, they completely withdrew their long-term 2027 financial targets due to, as they mentioned, volatility and higher customer acquisition costs and its self-serve small business channel. So if we move on to the next slide, um, fourth key and last takeaway here is that investors are now asking what the ROI is on their heavy AI related capital spending. So while the market demands the AI innovation push, market has been very unforgiving on major tech companies that forecast high capex without showing any immediate boost to their near-term revenue or cash flow. And the market is now considered impatient and they don't want to wait out multi-year infrastructure build-outs. And this is what you can see with Amazon and Alphabet. They suffered from negative stock reactions despite solid underlying business momentum. These are the majors. Amazon stock fell as it guided to a nearly 200 billion capex spend in 2026, while Alphabet likewise fell for raising its 2026 capex guidance to 175 to 185 billion. So what we're seeing is that investors are skeptical whether these large infra investments translate into real bottom line operating income. So basically, the bottom line here in this earnings is that we're now seeing a market where investors are demanding a push for usage or adoption of AI within these companies' line of business. And they actually have to show strong ROI for these AI usage or adoption, which the market then rewards. We have a deep dive per company in the segment view, which can read more offline. And then on the next slide, as I mentioned earlier, cloud revenues of these majors have been increasing, as can be seen on the upper left chart. So with Google Cloud at 47%, which is the highest, Azure at 39%, which remained relatively flat but still high, and the AWS at 24%, increasing from originally 20% last quarter. So for all three of these, management noted the same thing. Cloud growth is driven mainly still by the demand for enterprise AI and services. And the reason for this is that AI training and deploying AI models require higher amounts of computing power, storage, and scalability, which are resources provided by these cloud platforms. And this brings us to our main key takeaway here, which can be seen on the lower left chart. As you can see, the cloud revenue of these three majors are growing at a compounded quarterly growth rate of 9%, and it's the first time since 2021. So re-highlighting this reacceleration in demand.
committed to continue to push hard and invest to provide you with the best possible intelligence in the technology sector. Thank you for joining the session today. Have a wonderful few weeks. Thank you for the questions you asked. We'll come back to you offline on these ones, and looking forward to seeing you again soon. Thank you all. Bye-bye.